The dollar is slipping. Not collapsing overnight, not exploding into chaos, just quietly losing power. Your groceries cost more, your rent costs more, your insurance costs more, but your paycheck feels the same. This is not random. This is not bad luck. This is monetary design. And if you don't understand what's happening, you will slowly get poorer while thinking everything is normal. Let's break it down. 1. The illusion of a strong dollar. You'll hear politicians say the dollar is strong. They usually point to the Federal Reserve. They point to interest rates. They point to stock market highs. They show charts. They quote exchange rates. They talk about global demand. But here's the truth. There are two dollars. The dollar on paper, the dollar in your real life. On paper, it's measured against other currencies. It's compared to the euro, the yen, the pound. It's judged by foreign exchange markets. It rises and falls on trading screens. It reacts to rate hikes and bond yields. In real life, it's measured against milk, gas, housing, healthcare. It's measured at the grocery store. It's measured at the gas pump. It's measured in your rent payment. It's measured in your insurance bill. It's measured in tuition and prescriptions. And in real life, the dollar has been quietly shrinking. Not collapsing overnight, not exploding in headlines, just slowly losing strength. This is called purchasing power erosion. It means your money buys less, even if your paycheck stays the same, even if your raise looks bigger on paper, because prices rise faster than wages, because inflation compounds silently, because debt expands the money supply, because more dollars are chasing the same goods. It doesn't feel dramatic. It feels gradual. $1 extra here, $5 extra there, a subscription price creeping up, a grocery bill that never goes back down. That's what makes it dangerous. You don't panic. You adapt. You swipe the card, you move on. And slowly, the dollar in your real life becomes weaker than the dollar on paper. 2. Inflation, the silent tax. Inflation is not just prices going up. It's your money buying less. It's your paycheck stretching shorter. It's your savings losing strength. It's the same effort producing less comfort. Since 2020, trillions of dollars were created, not earned, not produced through new goods and services, created digitally. When the pandemic hit, the government and the Federal Reserve injected massive liquidity into the system. They acted fast. They acted aggressively. They wanted to prevent collapse. Stimulus checks, corporate bailouts, emergency lending, expanded unemployment benefits, PPP loans, bond buying programs. Money supply exploded. The number of dollars in circulation surged. Bank reserves swelled. Balance sheets expanded. And here's the rule. When you create more dollars without creating more real value, each dollar becomes weaker because money is a claim on goods and services. If the claims multiply but the goods don't, the value of each claim shrinks. Too many dollars, same amount of goods. Too much liquidity, limited supply chains. Result? Prices rise. Not instantly everywhere, but steadily across essentials. Food costs more. Rent climbs higher. Used cars spike. Energy jumps. Your dollar slips. Not because you failed, not because you worked less, not because you suddenly became irresponsible, because supply was diluted. More currency units, same real economy. And when money is diluted, purchasing power quietly fades. 3. Debt, America's addiction. The United States runs on debt. Not just occasionally, not just in emergencies, systemically. Government debt, corporate debt, consumer debt. Credit fuels growth. Borrowing funds expansion. Leverage drives the system forward. The U.S. national debt is over $30 trillion, and it keeps climbing, year after year, budget after budget. And here's the uncomfortable truth. A weaker dollar actually helps a country drowning in debt. It sounds backward, but it's financially logical. Why? Because inflation makes old debt cheaper to repay. Debt is fixed in nominal terms, but money's value is not fixed. If you borrowed $100 when money was strong and pay it back when money is weaker, you win, because that $100 no longer buys what it used to. Its purchasing power has declined. Its real weight has shrunk. Governments know this. They understand monetary mechanics. They understand long-term debt cycles. They understand inflation's quiet effect. Inflation quietly reduces the real burden of debt. It erodes liabilities over time. It softens the true cost of repayment. It shifts pressure away from borrowers. So, while you struggle with higher costs, while groceries climb, while rent rises, while insurance premiums spike, debt gets easier to manage at the federal level. Tax revenues rise with inflation. Nominal GDP increases. Old fixed-rate debt becomes lighter in real terms. That's not conspiracy. That's math. 4. Global confidence is shifting. The long-term trend changes. For decades, the US dollar has been the world's reserve currency. It became the backbone of global finance after Bretton Woods Agreement. It strengthened further after the petrodollar system emerged in the 1970s, and it has dominated international trade ever since. Oil is priced in dollars, contracts are written in dollars, energy markets revolve around dollar settlement, trade is settled in dollars, shipping invoices reference dollars, commodities clear in dollars, global reserves are held in dollars, sovereign wealth funds allocate in dollar assets. The greenback became the default store of liquidity. This created massive global demand. Countries needed dollars to trade. Banks needed dollars to lend. Markets needed dollars to function. But some countries are slowly diversifying, not with dramatic announcements, not with overnight revolutions, but with steady policy adjustments. Nations like China have expanded yuan-based trade agreements. Russia has reduced its dollar reserves. The BRICS bloc has discussed alternative settlement systems. Not ditching the dollar overnight, just reducing exposure, adding gold, increasing local currency trade, signing bilateral swap agreements. When global demand for dollars slows, even slightly, the structural support weakens. Its dominance softens at the edges. Its monopoly status becomes less absolute. This doesn't mean collapse tomorrow. It doesn't mean chaos next week. It means gradual pressure, slow shifts in reserve composition, small changes in trade settlement, incremental diversification over time. And currencies move on confidence. They move on trust. They move on belief in stability. If confidence shifts, even slightly, the long-term trend changes. 5. Why this matters to you. This is not about headlines, not about viral news clips, not about dramatic TV panels, not about one scary CPI report. This is about strategy. It's about positioning. It's about understanding trends. It's about protecting purchasing power over time. If the dollar slowly loses purchasing power, your effort buys less. Your time converts into fewer goods. Your savings shrink in real terms. Cash loses strength. Idle money decays quietly. What feels safe becomes fragile. Savings lose strength. Bank balances stay the same numerically, but their real-world value declines. Fixed income struggles. Bonds pay the same coupons, but those payments buy less each year. Retirees feel it first. Conservative investors feel it slowly. Anyone holding long-term cash feels it eventually. But assets? Assets adjust. They reprice. They adapt to monetary expansion. They reflect nominal growth. Real estate. Rents rise with inflation. Property values adjust upward over time. Businesses. Companies raise prices. Revenue climbs in nominal terms. Equities. Stocks represent ownership in real assets. Earnings expand as prices expand. Hard assets. Commodities respond to currency dilution. Scarcity holds value when money multiplies. The wealthy don't panic during currency weakness. They reposition. They shift from cash to assets. They move from passive holding to strategic allocation. They hedge against purchasing power erosion.
They understand that cash is a tool, not a vault. Cash is for liquidity. Cash is for opportunity. Cash is not meant for long-term storage in an inflationary system. If you sit in cash long-term while inflation eats at it, you are losing silently, not dramatically, not visibly, but steadily. 6. The power move. Here's the shift. Stop thinking in dollars. Stop obsessing over the number in your bank account. Stop measuring success by currency alone. Start thinking in value. Start thinking in purchasing power. Start thinking in ownership. Start thinking in control. Don't ask, how much money do I have? That question keeps you trapped in nominal terms. That question focuses on digits, not durability. Ask, what do I own?
Thank you for watching.